So 5 months ago, I made a major decision for my financial life. I decided to start a Smith Manoeuvre. What's that? Well, basically, I'm using the home equity line of credit that I have, and I'm withdrawing $500 a month, and I put that into the market. The whole idea of this maneuver is to transform a debt that is not tax deductible into a debt that is tax deductible. Let's take a look at my portfolio. 5 months later, I have 5 new stocks in my Smith Manoeuvre, and I also had to take another major decision for this plan. All right, so before I tell you what my 5 stocks are, let's take a look at what the portfolio looks like as of today. So we are on Dividend Stocks Rocks, where I can create all my portfolios and manage them. So it helps me to have a clear picture in one single image. As you imagine, great surprise here, we're 100% in equities, but what really matters is the sector allocation along with the pro ratings. Obviously, with 5 stocks, it's really hard to be completely diversified. You can see I have like 40% into financials, and then 20% in industrials, 20% utilities, and the real estate, my REIT that I bought, kind of suffered on the market, and this is why it's not at 20% as well. In terms of pro ratings and dividend safety score, I can see that my portfolio is in the green, which means that it is in good shape. The decent dividend, I'm going to have a little bit more than that. So dividend safety score rated of 3. 3 for a high yielder above 4 or 5%. That makes sense because you don't expect those companies to increase their dividend by a wide margin, like high single digit every year, for example. The growth rate will probably be a little bit more between like 2 and 5%. So that makes sense. I'm happy with that. There's nothing to signal over here. In terms of portfolio stats now, let's move it here. You can see the current value is 2,668, which is pretty cool because it means that I've made some profit. As you can see, the book value is slightly higher than 2,500. The reason is quite simple, is because I'm using a margin account. So from time to time, I'm going to withdraw a little bit of money. Like right now, I'm like at minus 25 bucks in the account. Why? Because I'm using that extra liquidity to have those 500 bucks in terms of shares. So sometimes like 530 to just like buy 1 or 2 more shares and have something equal. The portfolio yield at 4.5%. My goal was to generate more than 5%, more than 4%. In yield, so that works well. Annual dividend payment of 120, and if you go right here, what is very interesting is the 5-year dividend growth rate across my portfolio is at 5.42. This means that on top of having a 4.5 yield, my dividend will increase by more than 5% every single year if all things remains equal. In terms of rating and dividend safety score, now you have the weighted average that I have in my portfolio. So a little bit better than 4 for the pro rating and slightly under in terms of value for the dividend safety score. Again, very solid portfolio. That's a great start. And now let's take a look at my holdings. So what do you see here? I have my 5 companies. So I do have Brookfield Infrastructure, Exchange Income Corporation, Great-WestLife, National Bank, and Canadian Net Real Estate. Let's take a look at what Brookfield looks like. So I'm going to tell you 2 things I love about each of my holdings. So the major reason why I decided to add them to my portfolio. So for Brookfield Infrastructure, the first thing that I want to highlight here is its diversification. So BIP is a mixed bag of various utility businesses. It's almost like a utility ETF. Let's go down a little bit further into the investment thesis. Right here is just crazy. BIP manages 5,300 kilometers of electric transmission lines. They have railroads, they have toll roads, ports, natural gas pipelines, fiber backbone, and data centers. So basically they have everything you want in terms of utilities. It is backed by Brookfield Asset Management. And the second thing I really love is the generous dividend growth policy. So from 5 to 9% a year. So this one is paying a yield that is slightly under my objective, so only a forward yield of 3%, but a very strong dividend growth rate, a very solid business model, so I don't have to worry about this one for many years. Now let's go back to my portfolio and we are going to look at another company, so Exchange Income Corporation. So for those who don't know, Exchange Income has two business segments. That has nothing to do with one of the other. The first one is they offer transportation. It's an aerospace company, transportation in northern Canada. So the first thing I love about that is it is a sticky business. Even throughout the pandemic, they were still offering that service in a limited way, but they maintained their dividend while a lot of stocks in the aerospace got completely crushed. So it shows a lot of resilience. The second part of the business is a manufacturing business, but they're not necessarily manufacturing pieces for aerospace. They actually cover all kinds of industries. And this is one thing that I love about that is, yes, they have the aerospace sector, which is highly cyclical, but they have an industrial side manufacturing pieces for all kinds of industries, which is quite stable, and that helped them going through the pandemic. So for that part, they grow by acquisition, which is another thing that I really love about Exchange Income Fund. EIF also have a very solid yield, close to 5%, and that was able to maintain their dividend during the pandemic. That's all A's in the bulletin. Now, moving on to Great-WestLife, the last stock I added to my portfolio. So that purchase was made not too long ago. One of the largest life insurance business in Canada. They also have a lot of revenue coming from wealth management, more than $2 trillion with assets under management. And the two things I love about this one and two reasons why I decided to buy it. The first one is its yield. Around 6%. I got it while the stock price was going down a little, so it's a great opportunity for a Smith Manoeuvre. And the second thing that I love about this one is obviously it's the fact that it's being backed by Power Corporation. Huge business behind it. Great-WestLife is already a major player in their industry, so very stable. They have a great history of dividend growth as well. They didn't cut their dividend during the financial crisis of 2008, so a resilient business model. Once again, a high yield and some growth vectors and behind. I really like this kind of proposition for my Smith Manoeuvre portfolio. For the next one, National Bank, well, this will not come as a surprise, right? I had to have this one in my portfolio. The first thing that I love about this one and why I'm so bullish about National Bank is the dividend triangle. So when you look at it, you have revenues, earnings, and dividend that are growing almost all the time. This company has several growth vectors. We're talking about wealth management, we're talking about capital markets, we're talking about growth by acquisitions such as ABA Bank and Credigy. They have everything on their side. So the two things I love about National Bank, first, the dividend triangle is awesome, and the second thing is so many growth vectors. Now, the last company, not the least, Canadian Net REIT. Small company trading on venture capital, not optimal for the Smith Manoeuvre as well because they're paying a distribution, so it's not a dividend. So in terms of tax wise, not the best move I could make. REITs are definitely better into a tax sheltered account such as a TFSA or a RRSP or a LIRA. But nevertheless, I bought it. Why? Because it has double-digit dividend increase and double-digit FFO per share for the past 10 years. When you think about that, REITs are supposed to be like super boring, slow and steady, and this one is on a fast track. They spend a lot of money for growth and acquisition. They develop a bunch of projects and they generate a ton of cash flow. The second thing I really like about this one is the tenants type. When you look at REITs, this is one of the most important thing is to look at their tenants. So here you can see we have Loblaws, Walmart, Sobeys, Suncor, and Tim Hortons. Those companies will go through any kind of recession. Maybe not Suncor, but all the others are very stable. So it will. They're all like anchor base, grocery anchor base. So Loblaws, Walmart, Sobeys, and Tim Hortons are all related to the food business, and this provide management with predictable cash flow. Again, when you're taking some risk, doing a Smith Manoeuvre, and you're leveraging, you're using leveraging, it's really important to make sure that your portfolio is incredibly solid. The only downside about Canadian Net REIT would be that it is a small cap, so it is prone to higher fluctuation. This is why this one is actually down about 10% in my portfolio, as the other are generating profit. So this wraps up the Smith Manoeuvre portfolio review after 5 months. I'm very happy about where it's going. The dividend is there, the growth is there. I have been able to go through the kind of like hoops and loops of the market these days without getting too much hurt, so that's a great thing. Unfortunately, I had to take a major decision. I have to take a pause on this one, meaning that I will keep my 5 stocks, but I will not continue for a few months to put another $500 a month into that portfolio. The reason being is I traveled in Africa for a month. That cost me a little bit too much. I got like a little bit too excited. And when you use leverage, it's really important to create a balance between what you have in investment, your leverage, and also your personal finance situation. Right now, I'm a little bit tighter on my budget, so there's no need for me to take additional risk by using that extra $500 and put that into the market. So I'm gonna leave it into my line of credit. I'm gonna start paying down debts a little, and then in a few months I'll be able to jump back in. So the advantage is I was putting $500 a month, so that adds up very quickly. So in a few months I should be back on my feet, have a stable budget, and then I'll be able to start again to resume the Smith Manoeuvre strategy. In the meantime, I'm going to continue to rack up those dividends, and I'm pretty sure that this portfolio will just continue to grow over time. So let me know what you think about my picks, about where I'm going right now with that. Maybe you have other suggestions. I'm all ears. So again, the target is to have dividend growers with a yield above 4% to generate to create a portfolio generating like 4 to 5% dividend yield right up top, to make sure that I pay my interest on the line of credit. Don't forget to like this video, subscribe to the channel, and do not miss my next Thursday's videos. And until then, don't forget to stay invested.